It is a peculiar and recurring feature of financial history that the moments just before a significant stock market downturn often feel extraordinarily safe. In fact, it can feel like the safest time imaginable to be an investor. The preceding years may have delivered steady returns, even spectacular returns, lulling everyone into a comfortable state of optimism. You might look back at the performance of your portfolio over the last 5 years, 7 years, or even 10 years, and think to yourself that even the worst of those years was perfectly acceptable. This sense of security is deeply human. Our brains are wired to project the recent past into the indefinite future, creating a powerful illusion that the good times are here to stay. This feeling of comfort is reinforced by a mountain of seemingly rational data. Financial news outlets celebrate new market highs, and analysts project continued growth. Another classic sign that a market may be approaching a precarious peak is when discussions about investing spill out of the financial pages and into every corner of daily life. Suddenly, it seems as though everyone is a stock market genius. You might find yourself in a coffee shop, a taxi, or at a family barbecue. The conversation inevitably turns to the latest hot stock or cryptocurrency. People who previously had no interest in finance are now eagerly sharing tips and bragging about their recent gains. Think back to the Bitcoin frenzy of 2016 and 2017. It felt impossible to get into an Uber without the driver enthusiastically recounting their journey into digital currencies. This creates powerful social pressure to participate. Being on the sidelines or sticking to a conservative strategy starts to feel lonely and risky. Herd mentality can detach asset prices from fundamental value. Buying stops being about a company's earnings, its management team, or its long-term prospects. Instead, it's because the price has been going up, and you expect it to keep going up. This is a speculative bubble. Focus moves from long-term value creation to short-term price momentum. The initial phase of a market downturn often doesn't feel like the beginning of a crash. Instead, it is framed as a healthy correction. A little voice, conditioned by years of positive returns, starts whispering in the back of your head, "Buy the dip." This mantra echoes across social media and financial news shows. After all, for the past 5 or 10 years, every minor pullback has been rewarded with a swift recovery and new highs. The strategy has worked flawlessly. Why should this time be any different? This initial confidence makes investors feel like heroes. A 5% drop becomes 10, then 15. The chorus of "buy the dip" starts to grow quieter. As one financial advisor with over 2 decades of experience noted, everyone is a hero until the market is down 20% or 25%. Somewhere in that range, the confidence that was once so abundant begins to erode rapidly. Let's say you started with $100,000. Your portfolio grew to $300,000. Then the market falls by 33%. In a matter of weeks, you have watched $100,000 of your wealth vanish. After observing these recurring patterns, the initial calm, the crowd's excitement, the eventual panic, it might seem like there should be a reliable formula for predicting a crash. There is no single foolproof signal that always happens before a crash. If a perfect warning sign existed, everyone would see it and act on it. Crashes must, to some extent, be a surprise. Factors are often correlated with crashes, but correlation isn't causation. Example, rising unemployment is frequently associated with downturns. Yet not every rise in unemployment causes a crash. Each crash is unique to its time and circumstances. Dot-com bubble. Irrational exuberance over new tech. 2008, housing collapse and mortgage securities. 2020 downturn, global pandemic outside the financial system. Chasing out at the top, back in at the bottom is a dangerous fantasy. It requires 2 perfectly timed decisions, one to sell, one to buy. The odds of getting even one right are incredibly low. If the period before a crash is marked by deceptive calm, the bottom of a crash is its polar opposite, maximum fear and pessimism. It feels like the absolute scariest time to be an investor. News headlines are relentlessly bleak: economic ruin, corporate bankruptcies, widespread job losses. Experts on TV predict only worse to come. At the market bottom, everyone says you should sell, that staying in would be foolish. The pressure to stampede out is at its most intense. Interestingly, a subtle sign a market may be bottoming is when overwhelmingly bad news is released, and the market fails to fall further. It treads water or even inches up. That's a quiet signal selling pressure is exhausted, a capitulation seen from the other side. The investors left are often those who would never sell. They are long-term believers with durable strategies and conviction. They're not focused on daily price swings, but on company fundamentals, solid balance sheet, capable management, robust revenues. They expect true value to return. The point of maximum financial opportunity is almost always at maximum psychological pain. The scariest time to invest is often the best time to invest. Given that there is no reliable signal to get out before a crash and no all-clear sign at the bottom, what is a retail investor supposed to do? The answer is both simple and incredibly difficult. Have a long-term strategy and stick with it. This is not the exciting advice that promises to help you time the market perfectly, but it is the only advice that has consistently worked over the long run. Your investment strategy should not be based on your emotions, your fears, or the daily headlines. It should be based on your personal goals, your time horizon, your genuine tolerance for risk. This plan should outline your asset allocation, the percentage of your portfolio you will hold in stocks, bonds, and other assets. A younger investor with decades until retirement can afford a higher allocation to stocks. An investor nearing retirement will likely want a more conservative mix to protect their capital. The key is to make these decisions during a time of calm reflection, not in the middle of a gut-wrenching market panic. Once you have this plan, you must treat it like a sacred text. Your goal is to modify your plan as your life circumstances change. A new job, a growing family, an approaching retirement date. But not as the stock market happens. The market's volatility is a feature, not a bug. By having a pre-committed strategy, you create an anchor that can hold you steady against fear and greed. Success comes from basic blocking and tackling, saving consistently, diversifying broadly, managing costs, and staying the course. For many people, the best way to ensure they stick to their long-term plan is to work with a trusted guide. The gold standard is a fee-only financial advisor who acts as a fiduciary. A fiduciary has a legal and ethical obligation to act in your best interest 100% of the time, a crucial distinction. These professionals have been through numerous market cycles and have helped hundreds of families navigate emotional turmoil. They provide expert portfolio management and behavioral coaching to keep you from making fear-driven decisions. Of course, many people prefer a do-it-yourself approach. If you choose this path, equip yourself with the right tools and a healthy dose of humility. Avoid building a complex plan in a spreadsheet. A single formula error can be catastrophic. Use software built for planning instead. Tools like New Retirement Now Bolden can help model different scenarios. They track your progress and build a comprehensive retirement plan. Whether you work with an advisor or go it alone, your plan is your primary defense. It must be built on a solid understanding of your finances and goals. This is not about get-rich-quick programs. Success in investing comes from basic plays. Save consistently, diversify broadly, manage costs, stay the course, do your homework and choose your strategy wisely.